So, thank you. Can you guys hear me? So, this is ShengQuan from Bloomberg Quant Research. I'm going to talk about supply chain and factor investing. So, I'm going to briefly talk about global supply chain network and, in particular, Bloomberg supply chain dataset. Then, we'll go to talk about company relationships and how to derive company metrics from the supply chain relationships. And we'll briefly talk about the nutshell, factor and factor investing in a nutshell, and test our factors at the end. Okay. So this is a kind of illustration of a supply chain from Intel's perspective. So on the left-hand side is Intel suppliers, on the right side it's its customers. So you can see some materials company on the left and say Apple on the right. So if you have a Bloomberg terminal, you will see a more kind of a elaborate version of it. If you run SPLC, you'll find like there are hundreds of relationships, both on the supplier end and customer end for Intel, right? And there are more details about it on the screen. So mathematically speaking, a supply chain relationship is characterized by a supplier and company and customer, a start date and end date of the relationship. And usually if the relationship is quantified, you have a value. It could be a dollar value of a relationship, or it could be some percentage ratio. For example, from the supplier's perspective, what is the revenue percentage I generated from this customer as a percentage of my whole revenue, right? Usually, from the supplier, from the customer's perspective, there's a cost account associated with the relationship. Could it's COGS, or it's a CapEx account, or it's R&D cost, etc. And there are other metadata around it, like data source, when this record created, when it's updated, right? So Bloomberg supply chain dataset covers about 35,000 public companies and about 200,000 private companies. If you take all the historical relationship into account, in total, there are about more than 1 million such relationships in record. And we have the relationship history from 2006, and we're starting estimating relationship from 2011. So that basically there's a whole kind of a global data group, analysts working on extracting these relationships from financial reports, from earnings calls, and various data sources. Some descriptive statistics. So the majority of the relationship covered by our datasets is in APAC. Here is the major suppliers kind of recorded in the data set. You have China, Canada, and United States. Analogously, we have the similar distribution for the customers. Actually, the list of major customers is kind of essentially the same as the major suppliers, except that Canada is not in the list. So before we delve into our focus of this talk, there are basically various kind of connections with the supply chain and other market variables. And some fundamental studies, like focusing on how kind of supply chain impact earnings and shock propagation. For example, the Volkswagen emission case many years earlier, how does it impact its supply chain? And Bloomberg actually also generate automated news based on supply chain. And how does weather effects impact factories and retailers? A knowledge graph in general. ESG topic is very kind of a hot topic these days, with an increasing awareness on environmental, social governance issue. So when we're looking at the ESG characteristic of a company, naturally we would like to also investigate the ESG of its characteristics of the suppliers, right? But in this talk, we will kind of focus on one particular topic, which is factor investing, how to derive metrics, company metrics from supply chain data, and how to use that as an equity factor. So basically in this illustration, I'm kind of showing in the center of the blue circle, and kind of illustrates a supplier and a number of customers around it, right? So from the supplier's perspective, you can think of there's a kind of various kind of data associated with the relationship edge and also the customer nodes. And the goal will be aggregating those edge information into a node information and assign it as a score to the supplier. And we treat it as a factor. We'll talk about what the factor means, but later. So we'll talk about several kinds of metrics. For example, the first one is concentration. This is more of a health score. So concentration measures how costs are distributed among the suppliers from a customer perspective, or equivalently, how revenues are distributed among customers from a supplier's perspective. One kind of concentration score is called entropy. It's defined by the relationship weights times the log of the relationship weights, and you sum over all the customers, for example, from the supplier's perspective. And this number has a range from 0 to log ni, when ni is the number of customers for the supplier. And a kind of similar score called HHI, defined similarly. Basically, a higher entropy indicates lower concentration, and the higher HHI indicates higher concentration. You don't want, from a risk management perspective, you don't want your too much concentration on a single supplier. Okay. A second kind of score we talk about is domination. This is kind of an interesting factor. We first define what we mean by pairwise domination. So the cost percentage ij in the numerator means, let's see, from a customer perspective, between a supplier I and a customer J. From the customer J's perspective, what is the cost induced by the supplier as a percentage of my total cost? And similarly, revenue percentage ij means from the supplier's perspective, what's the revenue generated from this customer as a percentage of my total revenue, right? And you define this ratio accordingly. And this number is between -1 and +1. And we interpret dij around 0 as a kind of a balanced relationship. And the large positive value means supplier is dominating the customer, and equivalent analogously, a negative number means the customer is dominating the supplier. Just think about it. So if you are a supplier and the revenue you generate from this customer is only a small percentage of your total revenue. But from the customer perspective, the cost spent on the supplier is a large percentage of the cost. That means the supplier is dominating the customer. Okay? Once you have the pairwise domination, you form a kind of a weighted average of the pairwise score and assign it respectively to the supplier and customer. You form a node-wise company metric we call the domination score. Here's a distribution of the pairwise domination all over the history, I think since 2012 of the data set I've used. So you've seen there's kind of a fair amount of a relationship that's kind of being dominated from either side. The third kind of a score we talk about and test is centrality. So unlike domination and concentration we talked about earlier, which is kind of we would say, local calculation. You only need to look at your direct links in the supply chain to do the calculation. In this case, it's actually a global metric. It measures the kind of importance of a company in the entire supply chain network. So if you define a relationship matrix Aij, where the element Ij, it could be a binary variable, if it could be 1 if there's a relationship, or 0 if there's no relationship, or it could be some quantitative value if you have a quantified relationship. The simplest kind of a centrality is called degree centrality, which is nothing more than just counting the number of customers for a supplier, or counting the number of suppliers for the customer, right? That's still a local calculation. But the one we'll be focusing on is called the Kleinberg centrality. So it's what it means that the idea is basically, let's just read the original words from Kleinberg in 1998. A node is an authority if it's linked to hubs, if it is hub if it's linked to authorities. In the language of suppliers and customers, I would say a supplier is a very central supplier if it is a supplier to many, many central customers. And a customer is a very central customer if it is a customer of the many central suppliers. So if you define the vector S, just to point out, this vector Si is a supplier centrality score, and the vector Cj, C, is the customer centrality score. Basically, I represent the supplier centrality as a linear combination of the customer centrality of its customers and vice versa. Right? Mathematically, in matrix vector notation, you would say S is matrix product between A and C. C is a matrix product of A transpose and C. Right? To solve this problem naively, you just run a kind of eigenvalue problem of A times A transpose. But this could be a very large matrix because, as we said, we have like 200,000 companies in the global network. So it could be a 200,000 by 200,000 matrix. But it's not so hard indeed because you don't need all the eigenvalues and eigenvectors. All you need is the eigenvector where all the elements are positive. So there's a kind of you basically solve the equation self-consistently in an iterative manner. Okay. Yeah, I've already covered this slide. The final kind of factor we'll talk about is called Cos Momentum. Again, unlike all the previous factors we talked about, which is calculated based only on supply chain relationships, this one combines supply chain relationship and market dynamics. So before we talk about Cos Momentum, we talk about what is momentum, right? So I think in the theory of asset pricing, one of the very first asset pricing model is CAPM, capital asset pricing model, developed in 1970s, which kind of try to explain the asset returns, for example, stock returns in terms of the market returns. And in early 1990s, Farmer French enhanced the model with two other more factors, which are market cap, called size factor, and value, which is book to market ratio, value factor. And in late 1990s, Carhart further enhanced the model to be called Farmer French Carhart model, which includes additional factor called momentum. What momentum is basically, there are many ways to estimate momentum. The simplest one is just calculate historical returns of the past year. To be more precise, it's the historical return from 1 year ago and 1 month ago to exclude the latest month. The reason is that momentum is kind of trend following signal, which actually has long gone. It's no longer actually generating premium recently. So that's why we need to exclude the latest month to kind of remove the mean reversion effects from the latest month. So this factor, this is the traditional momentum factor. But here we're going to talk about the customer momentum, which is instead of looking at the company itself, we look at all the customers and we calculate the momentum of each customer and take a weighted average of these customer momentum, assign it as a score to the central company as a supplier, right? So that's where the formula says. So here momentum is the momentum, regular momentum for each customer company J, and we take a weighted average and assign it to the company I, which is a supplier in the center. Where the momentum is just calculated as usual as a historical price return, right? So this is 12 months ago, this is 1 month ago. Right? But of course, you can, regular momentum is usually calculated over a longer horizon, like 12 months. In this case, we will investigate all kinds of horizon. We'll look at like 1 month return, 2 months, 3 months, 12 months, right? There's various kind of horizon you can take for the momentum calculation. So now let's talk about factor and factor investing in a nutshell. There are a lot of academic discussion around it, what the factor really means. But heuristically speaking, a factor can be thought of any characteristics of a company that kind of drive a broad group of companies' return and risk persistently. So it's two things. One is it has to be broad. It should apply to a broad group of companies, and also should be persistent. Right? You should see persistent risk premium generated from this factor over history. The two kinds of factors, one called macroeconomic, which applies to all asset classes. For example, interest rates and crude oil. Basically, it affects all the asset classes. Another kind of it is called style factors, which applies to a particular asset class. In this particular case, we are talking about equities, right? And there's also a kind of theory about why certain factors earn a premium in history. The most plausible explanation is that it's compensation for taking risk. Of course, if you think market is not very efficient, maybe it's caused by inefficiency in the market or by some constraints, or can be caused by investors' bias. But the most reasonable explanation is that if you take a risk through an exposure to the particular factor, the premium is for you to kind of a compensation for you to take the premium, to take the risk. And the factor investing is just the process of trying to harvest this premium through exposure to the factor. So the space-time of financial market typically has two dimensions. One is the security universe, another is time. And accordingly, a factor model can be formulated in two different ways, in cross-section or in time series. Right? It kind of reflects two idealistic paradigms of trading. The first one is you take actions periodically, say at the end of each month. At the end of each month, you kind of select your stocks and weighting the stocks to form a portfolio, and you do the same thing every month. Right? That's the kind of cross-sectionally way of doing things. Another way is doing kind of operating on the time axis. You focus on one particular asset, and you kind of decide your entry and exit position along the time for this particular asset, and do the same thing for each asset individually. So mathematically, we will use linear factor model. Linear factor model will try to express the asset returns as a decomposition of factor exposure matrix and factor returns. So let me just explain it in a bit more detail. In matrix vector form, we write the relationship in this form. So this is the asset return vector. It has n rows. Each row corresponds to one asset, say one stock. So let's say there are 500 stocks. So IBM, Microsoft, Apple, GE. So there's 500 stocks. And each entry is kind of the return, say, from tomorrow and today, from today to tomorrow, as the elements of this vector. And I try to decompose this vector of asset returns as linear combinations of some factors. We'll talk about how to estimate these two. The matrix is called factor exposure matrix. And again, each row corresponds to one stock, and each column corresponds to one factor. So typically, you have much more stock than the number of factors. You have 500 stocks, but you only have 4 factors in the Farmer-French-Carhart model, right? So this will be the market exposure. This will be the size and value and momentum. And correspondingly, you will have 4 factor returns here. The factor return for market, size, value, and momentum, right? And this is the residual of this form. We call it idiosyncratic returns. This model can be formulated as a contemporaneous way or as a forecasting, right? So if there's a delta, if we're talking about the return in the future, then it's a forecasting equation. If there's t and the time t here is the same time, then it's contemporaneous. So a lot of the factor asset pricing model focus on how to estimate the right hand side of the equation, because on the left hand side the return is known if you observe it from the market. There are 2 different ways. One is called bar approach. Bar approach assumes that the factor exposure matrix, basically the X matrix, is known. You take it as, for example, you fill the elements of this matrix to be the book-to-market ratio of the company, or the momentum of this company, or the market cap. So basically you know the factor exposure matrix X, and you estimate the factor return beta by cross-sectional linear regression. You basically invert this equation by least square fitting, right? The second way is called the Farmer-French approach, which is actually used by Farmer-French originally. So in this case, you did the other way around. You kind of assume you know what the beta is. And how the way they estimate beta is extremely simple. It's by sorting, right? Of course, by market returns, you just aggregate, for the beta corresponding market, you just aggregate a kind of value aggregation of all the assets in the security universe. And that portfolio's return will be the market return. And for another asset, for example, the value factor, and you look at the book-to-market ratio of each asset, and you sort all the companies according to their book-to-market ratio, from the highest to the lowest. You divide them into 5 quintiles. And you long the top quintile and short the bottom quintile. It basically form a long-short portfolio kind of associated with the value factor. And you identify this long-short portfolio as the factor portfolio of the value factor. But then you basically know what the beta for the value is, for the value factor. Once you estimate all the betas, you will get the X matrix by time series regression, okay, for each asset individually. So in this work, we actually use the Farmer French approach. There are pros and cons for, let me just go to this slide first. They are essentially the same thing, just two different ways of kind of decomposing asset returns into exposure and the factor returns. But they have pros and cons. The bar approach, the advantage that they have pure factor exposure. You make sure that the factor portfolio of this factor has no exposure to another factor. And it's generalized easily to multiple factors. The disadvantage that you can only basically, the model is inherently linear. You can only create one factor portfolio for each factor. On the other hand, the Farmer-French approach, the advantage is that you can form various kinds of factor portfolios. You can long the top quintile, short the bottom quintile, or you can like long the middle quintile and short the bottom and top. Right? There's more flexibility there. The disadvantage that it's very hard to disentangle the factors. It's hard to make sure that the value factor created this way has no exposure to the size factor, right? And it's not easy to generalize the multiple factors. And in this work, we'll do it in another way, called basically the third bullet points. We're still kind of using Farmer-French approach, simple long-short to form simple long-short portfolio for each factor, but we'll adjust the P&L of this factor portfolio in time series using time series regression by regressed against all the known factors, for example, market factor, psi. So I'm using the kind of typical terminology. This is called market factor. This small minus big, which is a size factor. High minus low is the value factor in momentum. This is kind of they call it the Farmer-French Carhart four-factor model, which sort of means there's four kinds of well-known factors. I just want to make sure, and when I'm testing a new factor, I want to make sure it's not something already known. I want to take out the components from the known factors and I only want to look at the residual alpha, which we interpret it as kind of trading signal. There are some technicalities. Basically, the first one is how often do you resample your factors? In this case, we do monthly. Basically means at the beginning of every month, I look at my factor exposures and decide the membership of the top quintile and the bottom quintile, right? Another issue is called rebalance. It means, think about it, at the beginning of each month, you determine the membership of top quintile and bottom quintile and form a long-short portfolio and let them evolve over the month. Of course, maybe the top quintile performs better, so the notional although originally you kind of distribute equal notional on the long and short, but by the end of the month, the top quintile could have more notional in it. So you may want to kind of redistribute the notional such that on the beginning of the second month, you still have the same notional in the long and short, right? Or you can choose not to rebalance. It's a matter of choice. Let me just briefly show earlier slide. So here is the test. The security universe will be Russell 3000 time period from 2013 to 2017. The frequency rebalance is actually daily in this case. The four charts shows here the market beta factor, market portfolio. The top left will be the size, the market cap. The bottom left is the value factor, the booked market ratio, and the fourth one is the momentum. So the gray line is the Farmer-French approach. I actually downloaded from Farmer-French website. The blue line is generated from the bar approach. As you see, they're not exactly the same, but they are comparable. They're more or less telling the same story, except the beta factor. The beta factor is different because in the Farmer-French approach, the factor portfolio is kind of value aggregated. value-weighted portfolio. But in the bar approach I'm using, it's a beta-weighted portfolio. And the Russell 3000 is kind of large universe. So it's kind of different. If you choose SP 500 as the security universe, they will look much the same, because for large cap stocks, the value-weighted scheme and kind of a beta-weighted scheme are more or less the same. But for Russell 3000, there's a difference. So, okay, this is the last section. We're going to test the various kind of metrics we talked about earlier. I'll test the domination score. The security universe will be SP 500. Time period 2012 to 2019. We rebalance our resampling frequencies monthly, and of course the portfolio time series can be measured every day, right? It's daily. So there are two charts here. The left chart corresponds to the factor we rebalance every month, and the right chart there's no rebalance. We just say we put $1 in the top quintile and $1 in the bottom quintile, and just let it evolve separately. And in this case, we rebalance every month. So we're focused on this case, but they're the same eventually, but we'll focus on the left. So the blue line will be the top quintile, and the red line is the bottom quintile. And this in the middle, I think it's orange or green. It is a long-short portfolio, basically long the top quintile and short the bottom quintile. So we are measuring here we are measuring the performance of the portfolio by something called Sharpe ratio. For those who are not in financial industry, to briefly explain, it measures it's kind of a ratio between the expected returns and the volatility of the returns. Basically, the larger Sharpe ratio is, you consider it's a higher performance. And for a 5-year backtesting, I think a Sharpe ratio greater than 0.7 is considered statistically significant. And usually if it's larger than 1, you think it's a kind of a significant signal, right? In this case, it's 0.64, reasonable performance. As you can see, on the right side, when we don't take any, we do not rebalance, just let the top quintile and bottom quintile evolve separately, it looks like it's generating a higher Sharpe ratio. But we shouldn't be too happy about that. Because you need to adjust by some known factors, some other known factors. How could you tell you're not just repeating something already known, right? From a friend, Carhart has already discovered 4 factors. So on this chart, let me see, yeah. Again, on the left side, it's the monthly rebalance. On the right side, it's the no rebalance. And the green line is the long-short portfolio we constructed earlier on the previous slide. And the gray line is after Fromm-French Carhart adjustment. Basically, it's the residual. It's the residual we defined in this equation. Basically, after you take out all the components explained by known factors, and you only look at the alpha, is the gray line. So you can see that if you do monthly rebalance, your factor portfolio is actually pretty much market neutral. It doesn't have exposure to market, value, size, or regular momentum. So even after adjustment, the gray line is roughly the same as the original. But if you, on the right side, if you do not do any rebalance, basically in this case, the top quintile performs better than the bottom quintile. So more and more notional is kind of allocated to the top quintile, and you're gaining more and more market exposure. So that's why after you take out the well-known components explained by Fromm-French Carhart, the gray line actually has worse performance. And after adjustment, they both look the same, right? The alpha on the left side is 0.61, on the other hand, on the right side is 0.62. So basically, it's ended up with the same thing once you have adjust with all the known factors. One thing I want to mention, one of the benefits to forming long-short portfolio is, you'll see this market drawdown here. That's the end of 2018. You have a kind of a lot of funds lost money. And forming a long-short portfolio, kind of you hedge one of them against the other. So the factor portfolio doesn't really suffer from the market drawdown, because you're long this one and short this one, and sort of they cancel each other. Right? Now, next we're going to talk about the Kleinberg centrality. It's also very interesting. In this case, the long-short portfolio is actually going down. That means if you long the the very central companies and short the bottom quintile of low centrality, you actually end up with a losing portfolio. Of course, if you know that, you would kind of flip it the other way around. You can long the low centrality and short the high centrality, right? And it's quite significant. You can see you have a Sharpe ratio with a magnitude near 1. And when I first looked at the result, I was pretty excited. I showed one of my colleagues, and he questioned me with this. He said he looked into the kind of membership of the quintile and found a lot of suppliers to oil and gas industry in the bad quintile. And he said, okay, I can actually generate the same P&L with a much simpler portfolio, which is long the energy sector and short the market, which generates pretty much the same thing. So you can say your effective strategy is nothing more than a bet on the energy sector. So I tried to convince him that there's more than that. So okay, I'll do the same thing. But in this case, in addition to adjusting the factor returns by Pharma, French, and Carhart, I'll adjust by the energy sector in addition, right? So in this case, we do the same kind of adjustments. The green line is the original, the raw factor portfolio P&L, and the gray line, the white line is the adjustment by Pharma, French, Carhart, and the gray line is adjustment by Pharma, French, Carhart and energy sector. As you can see, this factor is kind of pretty much neutral to the conventional Pharma, French, Carhart, but it does have a significant adjustment by the energy. It has a kind of significant component in the energy sector. So once you take energy sector into account, the magnitude of the Sharpe ratio decreases a lot. But it's still above 0.7. It means that it has a large loading on the energy sector, but definitely not everything. On the right side, again, is the scheme without any rebalance. So in this case, again, see after the adjustment by all the kind of factors you would know, you get roughly the same Sharpe ratio. You know, in this kind of story, eventually, if you include more and more factors, you can always kill a factor to nothing, right? But the thing is, in academic papers, it's kind of a common practice to at least consider the commonly well-known factors. So the final factor we're going to test is called the Cos Momentum, specifically revenue-weighted Cos Momentum. Again, the same security universe, the same time period, and same kind of scheme. Now we're only considering the monthly rebalance and monthly resampling. We're not going to consider the no rebalance scheme because it's end up with the same as the rebalance scheme. So in this particular case, I'm showing two charts. They correspond to the momentum calculation of two horizons, 1 month, 2 month, 3 month, and 12 month. So I've also tested with the momentum with much shorter period, say 1 week momentum. But it turns out those kind of extremely short horizon return momentum are very hot noisy. They don't generate any signals. The interesting story here is that if you look at only the raw P&L series, actually the long-term momentum has a very significant overlap with the regular momentum factor. That sort of makes sense because think of it's kind of related to how efficient the supply chain network is to transmit information from customer to suppliers. It looks like it's going to take several months to kind of incorporate the customer information to kind of instantiate it as a supplier return. So that's why if you look at long-term momentum, the Cos momentum and the supply momentum are roughly the same thing. They look similar. But if you look at the short-term momentum, say 1 month, they're different. That means Cos momentum factor is a different driver from the conventional momentum, right? So here, the green line is the raw Cos momentum factor. The gray line is the white line is the regular momentum, and the gray line is the adjustment of Pharma French plus the regular momentum. Right? So actually, 1 month momentum generates a significant Sharpe ratio. That's around the times. I think that's around the time scale where the customer momentum has predictive power for the supplier momentum, but the information has not been completely incorporated into the supplier's own momentum yet. Right? Well, this slide you may wonder why actually in this case the pharma-French adjust Sharpe ratio is enhanced compared to the raw Sharpe ratio. And that's because the Cos momentum and and regular momentum has more or less the same randomness. So actually, when you hedge the factor portfolio with the regular momentum, you kind of reduce the volatility of the factor portfolio. Yeah. So at the very end, I will test one more factor, which is a combination of Cos momentum and domination. So intuitively speaking, you might want, I think it's a good story that your customer's performance affect the supplier's performance, but intuitively speaking, it's only, I think it's the predictive power is stronger if you include only those customers that are dominating the supplier, right? So we're going to construct the same factor, customer momentum as an aggregate average, but only including, we adjust weights with a kind of indicator function here. We're only including the customers that has a domination score the large domination score. So imagine you are a supplier, you have, of course, your performance will be kind of heavily impacted by the customers dominating you. And here is one example. So let's see. So the blue line is the original, the one without any constraints. Basically, the 1 month customer momentum on the top left chart is the blue line here. And the green line and red line are the customer momentum with condition on the domination score. It can actually generate higher performance. Of course, you don't want to do that too much, because if you impose a very high threshold on the domination score, you decrease the coverage. Probably the supplier will end up with only one customer in your customer list, and that's going to cause idiosyncratic effects, right? So this is the end of the talk. So we briefly scratched the surface of the Bloomberg supply chain dataset. I would like to present this in a data science conference because it's actually a rich field for you to experiment the network structure of supply chain and its interaction with market dynamics. And it's from an academic point of view, it also provides interesting use cases for graph theory-based methods. And hopefully we kind of provide evidence that equity factors derived from the supply chain provide added value to the investment process. Yeah. Thank you.